Jubilant Foodworks posted a mixed performance in Q4 FY22. While the operating performance beat estimates, net profit was marginally lower than expectations. The network addition in core brand Domino's would continue. Jubilant is also scaling up the recently launched Popeyes brand. The announcement of new CEO with rich experience in various reputed consumer-facing organizations removes a key leadership overhang that Jubilant had been facing over the past 2-3 months. The company also said that opening of a store in the vicinity of existing stores to reduce delivery time, essentially a split store format, is unlikely to have material impact on profitability. JFL concentrates on store matrices strongly before opening any new store and stated that store payback period continues to be in the range of 2 to 3 years. Jubilant Foods Sri Lanka exposure is minimal and posted decent performance in Q4 amid a challenging macro scenario. Also, the Russia business, which is under DP Eurasia, in which JFL holds about 40% stake, has been going on as usual and has not seen any adverse impact of the Russia-Ukraine crisis so far. The stock, however, has underperformed, correcting by 30% in the past 4 months, whereas Nifty dropped 9% in the same time period. It's been one of the worst performers in quick service restaurant space post the announcement of split store strategy and the sudden resignation of MD and CEO. With Jubilant largely addressing these issues, we expect the stock to re-rate. Also, current stock valuations are attractive and we maintain a positive stance on the stock and advise investors to add the stock to their portfolio. JFL's revenue grew 13% YOY. Delivery business continued strong growth momentum, while the dine-in business was affected in the initial part of the quarter owing to the Omicron wave. JFL reported like-for-like growth of 5.8% YOY in Q4. Gross margins declined marginally owing to rising input costs. It undertook price increases in December 21, which helped mitigate the impact of these higher costs. EBITDA margins improved 50 basis points led by operating leverage owing to a healthy top-line growth. However, higher losses in associate companies and higher taxation led to net profits coming in a tad below expectations. JFL plans to scale up the core Domino's brand in India. It aims to open about 250 new stores in the current fiscal and aims to almost double the Domino's store count to more than 3,000 in the medium term. New stores opened will largely be a combination of split stores as well as opening stores in new towns. Apart from that, JFL will also open some stores in new macro markets in existing towns. It has also received strong response for the Popeyes brand launched in the latter part of the last fiscal year. JFL aims to open 20 to 30 new Popeyes stores in the current fiscal year, with the target to open 250 to 300 new stores in the medium term with nationwide presence. The company also plans to scale up Hong's Kitchen and Ekdum brands as well. However, expansion in these areas would be relatively lower and the company is still working on setting up the right strategy and business process before it can go for aggressive expansion of these brands. The appointment of Sameer Khetarpal as the MD and CEO to succeed Prateek Pota, who resigned a couple of months ago. Khetarpal has a rich experience of more than 25 years in the consumer businesses, having worked with reputed companies the likes of Hindustan Unilever, Amazon, McKinsey and GE Capital. In his prior stints, he built and transformed businesses through the use of technology. Among overall responsibilities of taking JFL forward, the new CEO would specifically focus on tech aspects and making JFL multi-brand as well as multi-country player, which is in line with the strategy outlined by the company earlier. Khetarpal will be joining JFL in September 22. His joining takes away the key overhang of leadership uncertainty created post Prateek Pota's resignation. JFL has been facing high input costs over the past 2 quarters as food and fuel costs have increased. To counter the impact, JFL has been taking price increases. It undertook a price hike of 5 to 6% in December 21 and took a similar 5 to 6% price hike in April as well. Also, JFL is improving operating efficiencies to counter input cost pressures. It stated that the input prices have stabilized as of now and it has been successful in largely passing on the cost increases so far. Also, the company has said that the new store openings, even the split stores, are not margin dilutive. The store payback period remains between 2 to 3 years and the company uses stringent store level revenue as well as profitability matrices before opening a new store. JFL expects no material margin impact owing to store expansion. And overall, it expects to broadly maintain the margins in FY23 compared to FY22 levels. At the current market price, the stock is trading at a PE of 52 times its FY24 projected earnings. The current valuations are lower than the long-term historical average and are hence attractive.